Hello, everyone. Today we are talking with Tom Pastore, and today we're talking about, the valuation and the strategy behind if you happen to be so lucky to be an ultra high net worth individual and how to do your estate planning and your valuation, etc.
Yes, I'm Thomas Pastore. I'm the CEO and co-founder of Sanli, Pastore and Hill. We're in our 34th year providing financial advisory and business valuation services in three main portals. One is for trusts and estates and ultra net high worth individuals.
So, as not everyone has ultra high net worth, let's start the baseline as we like to. Who should be listening to the podcast? Who would benefit from it?
Definitely trust and estate attorneys, probate litigation attorneys, family lawyers involved in high stakes divorces with ultra high net worth individuals, wealth strategists, and insurance advisors.
So, is there, for the context of why we're talking about that today, are there new policies or new laws that have come into effect?
I think it's the laws that have stayed the same through the past several years through administrations. The fact that you have a very high exemption that looks like it's not going to sunset anytime soon provides a very, very good opportunity to gift more out of an estate and save taxes.
So, let's start with the valuation. How do you work with lawyers? How do you start this process? Obviously, I think it's better to be done ahead of time, right?
Definitely, you should plan as soon as possible because what you're going to be doing typically first is gifting. Okay, that's the foundation of this planning with high net worth and ultra high net worth individuals. So they're going to gift interest to most likely their children or other relatives. And so you want to start as early as possible in planning that and use valuation as a strategy. It's much more beyond just a simple compliance tool. Okay. You want to work with the attorneys as soon as possible. And then later on, usually you'll bring in CPAs and wealth advisors and insurance advisors.
What are you valuating there, and how does this gift tax work?
Yeah, well, typically we're valuing privately held businesses, real estate holding companies, carried interest in private equity and alternative investment companies, family limited partnerships or limited liability companies owning typically real estate or securities.
How long does this process take? How often are you updating it?
The process works such that if it's a business valuation, you're going to be analyzing the company's historical operations, its current operations, and its expected future operations. That includes examining its intellectual property, its management structure, the assembled workforce it has, its trade name, patents that it may have, and then you're going to look historically how the company has performed from a financial point of view, and you're going to also look at any projections or budgets that are available to test their reasonableness. All right. Along with that, you're doing independent industry and economic research, and that altogether results in your selection as an appraiser of the business valuation methods, and then your conclusions of value. And that often includes applying discounts for lack of control and marketability, because what's often done is non-voting or minority interest are gifted in private uh, companies or FLPs, family limited partnerships, or LLCs. And so there's an opportunity to apply substantial discounts, often resulting in a lower value, and there's more economic value being transferred out of the estate and
And how
subject to
does
less tax.
yeah. How does that work, and how do you even plan for this taxation of it, everything?
Well, they're the providers of the value, taxes on the value in the United States. And so the planning involves a team approach. So we provide the value, the lawyer takes it from there or provides us input also along the way of what he or she thinks is going to be gifted. But it's kind of a reiterative process because as we get the value, they might say, all right, the time to transfer is not now. Okay. They might figure let's look in 6 months or a year. Or they say, well, how much can we transfer? That valuation that we provide provides that answer. And so that's basically how that process works.
Okay, and that's talking about the gifts to trust process, right?
Yes, that is talking about the gifts to trust.
Okay, and then what happens if, a gift is later found out to be under or overvalued?
If it's undervalued, typically that's what the IRS is going to do, or any state agency in the United States where they have an estate tax. If it's found to be undervalued, they're going to say, well, you underpaid taxes. So now the correct value is this much higher, let's say 30% higher. So your tax on that is that. But the interest over time, since you underpaid your taxes to the present, has to be added to that. And then there can be penalties too. So it's not
Yeah.
a good situation to have a valuation that didn't support the value.
And is that usually something accidental, like you partnered with the wrong person, or is that something on purpose?
I think often it's just an appraiser that's inexperienced, perhaps, or unfortunately, got pressure from the other professionals to get a low value, and that's unfortunate because it has the consequences that we just discussed.
Now, how does estate tax valuation come in here, and how is that different from the gift tax?
Well, that comes in when someone passes away, right? And so on the date of their death, you have to measure the value. There are exceptions. You can have an alternative date of value 6 months later than the date of death if market conditions change and whatnot, such that you think the value will be either higher or lower. Because typically, if it's a married couple, the first to pass away, there is no estate tax. That sets basis for income tax. So typically, a value on the higher end of reasonable fair market value, supports less income tax paid later on. When it's the second spouse to pass away, that's when the estate tax kicks in. And so then you have to go through a valuation process that is completely the same as the one I described earlier.
Okay, what do people need to be careful about when they're now addressing tax valuation?
Yeah, I think it's always, you've got to be careful about audit risk. Okay. So again, you know, if the Internal Revenue Service or the state authorities are examining the return, and let's say it's the second to pass away spouse, and they think there's an undervaluation, the same circumstances, the same dire circumstances can occur as I described earlier under the gift tax situation. There's also too, it's like the other thing you want to watch for is consistency in methodology between gifts that were made recent to the date of death and the valuation being done at the date of death for the deceased. Okay, if there are inconsistencies, let's say in applications of discounts or lack of control, marketability, that can come up as an audit. Okay, because the IRS can go in and get the valuations that were done for gift tax purposes. Now, consistency is a double-edged sword, though, because if market conditions have changed, economic conditions and industry conditions have changed such that the valuation should be different at the date of death versus the date of gifts, then consistency can also be an audit trigger in that case.
Okay, absolutely. And I think auditing is one of everyone's nervous fear that they all have in the back of their mind. So they want to avoid it as much as possible. So when we're talking about ultra high net worth individuals and planning, trusts are often central to this, but they can create their own valuation issues that require careful coordination. How does that work? And what do people, and especially the lawyers, the financial advisors that are coordinating, what do they have to look for out?
Well, with trust, it depends on the type of trust because the way it's set up, it can be regarded as a gift, okay? Or it may be includable in a estate. So you got to be careful because an individual that passes away, you're going to look at what they own in title personally. But if they have several trusts, they may have to be included in the estate. They may have to be valued and they'll be taxed. And the other thing too is that it's beyond taxation. There's governance issues and fiduciary issues too. And the valuation can establish, a measure and a metric that, all the family needs to use. And it ensures if it's a good, well proper done valuation, it's part of the step in ensuring intergenerational smooth transitioning and whatnot of various assets in the estate. Yeah, that's basically from a legal standpoint, but there's an economic opportunity too, that at the time of funding a trust, you can lock in that value that if you think is going to appreciate over time, you save taxes because it'd be locked in at the funding value versus the appreciated value over time. This is most common in alternative investment, hedge funds, and private equity firms when they're starting a new investment fund, because what you want to do is value the carried interest that are being gifted. That is the appreciation factor that drives the value in a private equity or alternative investment or hedge fund. So if you lock them in at the date of funding, they're at typically much, much lower value and lower tax than they'll appreciate over time.
Wow. Okay. So all of these sound very logical and straightforward, but I'm sure it's not. And a lot of these, especially ultra high net worth cases, go to court and are disputed. So, how do you protect yourself and your loved ones in that situation?
Again, the first thing you start with is the team approach. Okay. You have your business valuation or real estate valuation, valuation appraisers, working with the trust and estate attorneys, working with the CPAs that will file the returns, and working with the wealth advisors and insurance advisors, because there are insurance mechanisms that can aid in funding taxes.
Okay. And then at your firm, are these players all under the same house? Do you hire just one particular person or how do you work with others?
Sure. So we'll work, there'll be separate independent professionals. So we'll work with the trust and estate attorneys at our firm. They may hire independent real estate appraisers. We'll work with them. Then the insurance advisors usually come in and plan based on the values we're coming up with, what kind of coverage they'll provide members of the family. And the wealth advisors, too, will probably advise us about securities that's owned in the estate or through family limited partnerships or LLCs. And they'll really plan more exactly with the family members. We're kind of out of that process at that point once we've provided our information.
And then how do you decide who to work with or how do you evaluate or refer to your customers, clients?
Well, basically, we work with, entrepreneurs, family legacy, ultra high net worth individuals, a lot of tech people, of course, these days, a lot of game clients, but we're pretty industry agnostic, so we're pretty broad. Okay. Obviously, we do our business development. IR Global is great for that. Social media is great for that. Having longevity of 34 years is also, you get a lot of good word of mouth in too.
And how do you decide which law firms to work with or other partners that you want to collaborate with?
Well, so of course, someone that's coming in, they decide they want to work with us. So, we do our background analyses. What is their reputation? What is their background? What types of clients do we know they have and whatnot? They have a specialty that's particularly helpful to the situation of our valuation.
And then how does this all fit in this gift tax, this wealth tax, this evaluation all fit together in this strategy as a high net wealth individual?
Valuation obviously drives a lot of the decision making, right? For generations present and coming up, it is something that has to be done with several different professionals, as I've said. We provide information from the standpoint of any privately held business, privately held real estate, alternative investments. We provide that information. And then the wealth manager that's measuring the wealth, they'll do the wealth planning on the liquid securities of the individuals, the ultra high net worth individuals, families, and estates. The insurance people come in and cover what they can with insurance. And the CPA files the tax returns. And often they are the keeper of all the assets, because with ultra high net worth individuals, even high net worth individuals, they can have real estate holdings all throughout the world, vintage automobiles. They have businesses in different parts of the country and the world too. And so the CPA acts as a gatekeeper in that process.
And I guess the holder of the documentation, because this must be clouds worth of documentation.
Yeah, it can be the CPA, often the trustees too, and the attorneys. And, you're getting fed information from several different parties. And that's more the rule than the exception.
Is there anything else I should be asking you?
The only thing I would say is in evaluation, do you want to make sure you have all the supporting documents for any of the analyses you're doing, and that you provide a narrative that when read, so it leads the reader to say, yeah, that conclusion of value is valid. So that you have to also explain very clearly how you've come to a conclusion, and explain how clearly you've come and used an assumption that is valid and reasonable.
Absolutely. Thank you so much, Tom. If those that enjoyed this, there's a lot of conversations you can find on Thomas's profile on the IR Global site. How should people get in touch?
Google Thomas Pastore, IR Global, you'll get right to my email and my phone number.
Thank you so much, and good luck to everyone going on this journey.